Welcome to Chapter 14 of the Wealth Management Essentials course. In this chapter, we'll be talking about protecting retirement income. There are 9 different learning objectives, although it's mainly around annuities, segregated funds, and the guaranteed minimum withdrawal benefit contracts within segregated funds. So first, we'll look at annuities. So annuity contracts have an annuitant or policyholder and an issuer. So the annuitant is the person who is receiving the money. It's based on their life, and they can also be considered the policyholder. They sort of work the opposite of life insurance, where with life insurance, you're giving the insurance company money, and if you pass away, then you get, or your estate gets this death benefit, this lump sum of money. Whereas with an annuity, you're giving them a lump sum and they're paying you monthly amounts for a certain period of time. If it is a life annuity, it could be for the rest of your life. So you can purchase life annuities, but you can also purchase some term annuities as well. Annuities are designed to provide insurance against a longevity risk, mainly the life annuities are. And then there is Assurus, which is a non-profit organization that provides protection to policyholders in situations where an insurance company becomes insolvent. So Assurus guarantees that the annuity policyholder will retain up to $2,000 per month or 85% of the promised monthly income benefit, whichever is higher. So if the annuity was to give them $3,000 per month and that insurance company became insolvent and went bankrupt, well, then it would be the higher of $2,000 or 85%. And 85% of $3,000, that would be $1,250. So you would get that amount per month if from Assurus if that company went insolvent. Now, as I mentioned, there are a lot of different types of annuities. So you can get a straight life annuity. So this pays the annuitant a guaranteed monthly or annual income until they die, regardless of how long the annuity was in place. There is no residual payment to a beneficiary or estate when the annuitant dies. There's also life annuities with a guaranteed period. So this is just a life annuity, but you can get that guaranteed period. So if you get one with a 15-year guaranteed term, for example, and you pass away in year 10, the annuity will pay out the additional 5 years of payments to your estate or named beneficiary. There is a joint life annuity, so this pays a married or common law couple as long as either spouse or partner is alive. The couple has a choice to have the payment a bit higher while they are both alive, and then it drops generally in half or to a third when one passes away, or they can just have a level amount. There's a term certain annuity, so these pay out within a specified number of years, usually for 5, 10, 15, or 20 years, and they can also have guarantees attached. And then there's the deferred annuity, so it allows payments to be put off for several years. So you could give an annuity company, let's say $10,000 today, and they're going to pay you a certain amount per month starting at age 65, for example. And again, there are a lot of different options for annuities. There's an installment refund annuity. So this guarantees that if the annuitant dies before having received the deposit amount, income payments will continue to the beneficiary until the whole amount is refunded. There's a life annuity with a cash refund, so the beneficiary receives a lump sum cash refund of the unpaid balance if the annuitant dies early. Impaired life annuities, so this is only for people with reduced life expectancy because of an illness or terminal illness. So medical evidence of the impairment, such as a physician's report, must be provided. And the annuity payments, they are higher than those for people of the same age without any of these health impairments. There's also participating annuities, so this provides for increased payments to the annuitant if the investment yields are higher than expected, or if the issuing company's expenses are lower than expected. There's also indexed annuities, which is just indexed with the cost of living. Variable annuities, so these provide monthly payments to the annuitant that vary according to the value of the investment in a segregated fund in which premiums are placed, and the floor is usually equal to 75% of premiums paid. Split annuities, this is when the funds available for annuity purchase are split between an immediate term certain annuity and a single premium deferred annuity. Integrated annuities are designed to bridge with OAS and CPP, meaning you get more before you turn 65 and then less after. Can also be seen, similar to a defined benefit pension plan that has that bridging benefit. And then prescribed annuities. So this overcomes uneven taxation by spreading the tax load over the life of the annuity. It is available only if non-registered funds are used to purchase the annuity. Then you have structured settlement. So structured settlement is the payment of money for a personal injury claim in which all or part of the settlement calls for future periodic payments. It's usually when someone has been on workers' comp due to an injury, they have part of their payments deferred and given them to as a lump sum when they're 65 years old that has to go towards purchasing an annuity. And this lump sum is usually tax-free. Then you have segregated funds. So they are investment pools similar to mutual funds, except they have an insurance component to it. They also have a maturity and death benefit guarantee. So they are provided through insurance, and they can be viewed as just a mutual fund with that insurance component. They're legally known as an individual variable insurance contract. They usually have higher fees than mutual funds due to providing additional guarantees. There's a variety of risk within segregated funds. So similar to mutual funds, you could have a segregated fund that might be leaning more toward the bond market, just a regular balanced segregated fund, and you can have some that lean more towards the stock market. So in terms of the guarantees on the segregated funds, there's the maturity guarantee, which usually offers at least 75% of the principal amount over a minimum of a 10-year holding period. So this means that if you put $10,000 in a segregated fund, then you have the protection that if that segregated fund is below 75%, so $7,500 in this case, 10 years from now or after the holding period, then you would get at least the $7,500 back. So you can see that this is highly unlikely that you'd get an investment that would be down 25% over the course of 10 or 15 years, especially if it's well diversified. So usually the benefits within segregated funds, well, it is debatable, but I find they aren't really worth it. They aren't really worth that additional management fee that you're paying. But then there's also the death benefit. So they usually offer at least 75% of the principal amount if the policyholder dies. So that one is maybe a little bit more beneficial, especially for older clients. But sometimes they do have maximum ages on the segregated funds where they offer that. And both the maturity and death benefit guarantees, they are usually 75%, but they can also be 100% with certain funds. It's just that the fees on those funds are usually a lot higher. And also, just like mutual funds, withdrawals can be made at any time, so they're not locked in and they are liquid. So some insurance companies, they do require that the person on whose life the death benefits are based on be no older than 80 years old. So again, that just further decreases the value of that death benefit guarantee. Segregated funds, they do have reset dates where the maturity guarantee may be reset after one term. So if the maturity guarantee is 10 years, then in 10 years you can reset your maturity guarantee for another 10 years. So if you buy a fund for $10,000 and 10 years from now its maturity is up, and let's say it's worth $12,000, well, you can lock in that $12,000 as your base value, and then 10 years from that. If it's below 75% at 12,000, then you'd get that money back. Payments from a segregated fund's maturity guarantee are taxable, however, so that's something to keep in mind. So even if the proceeds on the contract are less than the ACB, if they do bump you up to that maturity guarantee, it's taxable. You can name a beneficiary even in a non-registered account. So if you buy a seg fund in a non-registered account, you can name that beneficiary, which can help avoid probate fees. So that's one advantage and one sort of an obscure use to segregated funds. Most segregated funds, they are limited to 70 to 80% of equities. So since they are providing guarantees, they try to limit volatile investments. And then if you look at the guaranteed minimum withdrawal benefit contracts, or GMWB, so these are segregated funds with this additional benefit. So they're marketed as guaranteeing minimum withdrawals that protect investors' retirement savings from downside risk. So the product, what it does is it tracks a notional number. So this is the GMWB, which then has a guaranteed annual withdrawal of 3% to 5%. So they have two phases. One is the accumulation phase, where you just start investing into this investment. It grows in value. This notional number grows in value as well. Then you have the payout phase, where you can either take from the actual value of the contract, or you can take this guaranteed minimum withdrawal. So they do have three guarantees. One is the income guarantee, and then they have the maturity and death benefit guarantee. It does have the ability to pass probate and potential creditor protection, and Assurance protects up to $60,000 or 85% of the promised guarantee in the savings phase and or accumulation phase, and up to $2,000 per month or 85% of the promised income payment, whichever is higher. So we'll go through an example. So say $200,000 is invested in an RSP that will be used for retirement income soon. So year zero, $200,000 goes in, that's the market value, that's also the guaranteed withdrawal balance. So the GMWB offers at a minimum a flat income for a specified period, or sometimes for life. So in this case, it's offering at least 5% or $10,000 per year for 20 years. So the GMWB also offers that death benefit of at least 75% of the initial deposits, less any proportional withdrawals as well. So in the example, you can see that in year zero, both of them are worth $200,000. Then in year one, they take $10,000 from the investment. So the notional amount is down to $190. The market value is down to $193 because it grew a little bit. Year two, they take another $10,000 out. The investment actually grows quite well, so it would have had double-digit returns there. Year three, it grows as well with another $10,000 out. So it was a really great few years in the markets. Since the market value is $205, it's above the $200,000. They can sort of lock that in and reset the guaranteed withdrawal balance to $205, and so now that guaranteed withdrawal amount is now $10,250, so 5% of the $205. So now you can start taking that amount out, and you can see both amounts just continue to decrease. And if the market value is ever higher than the notional value, there are resets available every once in a while. You can see that in this product, it just shows that a reset is available in year 3 and 6. So it's not like you can do it every year, just whenever those resets are available. Now, the problem with these plans is that the fees on the investments are quite high, and the investment would usually grow much better in a mutual fund with lower fees. So quite often you can buy the segregated fund or GMWB version of a fund and then a mutual fund, and the fees with these products are usually at least 25 to 100 basis points higher quite often, the whole 100 basis points higher. And so the mutual fund is going to grow much better, which usually does better for you over time. And so those are all the main concepts in Chapter 14. I hope you found the chapter review helpful, and I'll see you all in Chapter 15.